Welcome to the Deep Dive. This is the show where we try to cut through all the noise, grab the important info, and, connect the dots on things happening around the world that shape things for you.
Exactly.
Today, we're diving into a real mix. Some big global financial stuff, digital policy fights, and something really key for your own finances.
Yeah,
A major change in how assets might get taxed.
that's right. We're aiming to pull out the key insights from the headlines, the research, make sense of it all so you walk away knowing not just what's up, but why it actually matters to you personally.
Okay, so what's on the agenda for this deep dive?
Well, we'll kick off with a huge international fraud case, really shows some weaknesses. Then we'll pivot to that digital tug of war, which could, change things for free speech online and trade. Then a bit of a surprising look at the housing market. And finally, what we're calling the main event, this unique tax reform in the Netherlands. It's a fascinating case study for a bigger trend, really, in how governments are starting to look at wealth.
Sounds like a lot to cover. Let's jump right in. All right, segment one. Let's start with that story stretching from Malaysia to the global banks.
Yeah.
KP Morgan Chase, huge American bank, got slapped with a $330 million fine. It's all tied to that notorious 1MDB state fund scandal.
Yeah, this 1MDB story is, it's almost a textbook case of modern financial fraud. The scale, how long it went on, it's something else.
Right.
Malaysia's state savings fund, 1MDB, was basically emptied out. And while JP Morgan's fine is, substantial, $330 million.
It's a lot of money.
It is, but Goldman Sachs paid over 10 times that for their role. The Southern China Morning Post had some details on how part of it worked. This entrepreneur, Mr. Justo, apparently posed as this super wealthy guy, claimed he had oil and gas concessions, and got massive loans using fake collateral.
So it's kind of a classic con, right? Big front, believable lies, borrowing against assets that just aren't there.
Exactly.
But what gets me is even now, with all the tech, the digital trails, these massive scams can still take decades to fully unravel. It really shows there are still blind spots.
Big time. And the global nature of it is key, too. JP Morgan Chase also got dinged separately in Switzerland for money laundering linked to the same 1MDB stuff.
Okay.
It just shows how tangled these financial crime networks get across borders, makes them incredibly hard to pin down, to prosecute.
Yeah.
So the insight for you isn't just big fraud happens, but how it really exploits cracks in the system, legal loopholes between countries. Even the big institutions aren't immune if the fraud is clever enough, persistent enough.
A sobering thought. Okay, let's switch gears from financial fraud to a different global tension. The digital world. Former President Trump has been pretty loud about Europe's Digital Services Act, the DSA, calling them censorship laws.
Yeah, targeting incredible American tech companies, as he put it.
Right, and this really throws up that whole debate, doesn't it? Free speech versus platform responsibility.
It really does, and we have a concrete example. Tom Van Lemon, he's a leader in the Libertarian Party over there, had a Twitter post taken down. Someone complained, cited the DSA rules against inciting hateful, offensive, discriminatory, or racist content.
Okay, but what was the post about?
Interestingly, it was apparently an etymological look at the word inflation, which just shows how broadly these rules could potentially be interpreted.
So the worry isn't just about, obviously illegal stuff, but that the DSA lets people flag content they just disagree with politically.
Potentially.
And the platforms, worried about fines, might just take things down to be safe. That feels like a slippery slope for open debate online.
It's definitely a concern being raised. And Trump's reaction, threatening more tariffs on European goods.
Of course.
So stepping back, this isn't just, political noise. It's a real debate about the future of online speech, how much power regulators should have over these giant tech platforms.
And the economic hit.
Exactly. The economic reality is that you, the consumer, end up paying if tariffs go up on imported stuff. It hits your wallet directly. It's a good reminder that these big international policy fights have real, everyday consequences.
Speaking of everyday impacts, let's move from digital fights to something more tangible. The housing market. We're looking at Miami specifically. Reports from the Daily Mail, Zillow data, suggesting prices are actually falling there. Seems like Miami's market is cooling off.
Yeah, and what's insightful here is the backdrop. Housing markets, especially hot ones like Miami, went absolutely wild during the pandemic.
Right.
A lot of that was fueled by central banks printing massive amounts of money. That money had to go somewhere, and a lot flowed into assets like housing.
Okay.
That sort of artificial boost seems to be wearing off now. The stat is something like 70% of sales are happening below the asking price. That signals a pretty clear end to those crazy bidding wars we saw.
So is this good news or bad news? I mean, lower prices could make housing more affordable for some people, which sounds good. But does it signal something deeper, economically speaking? Is it a red flag?
Well, this is where it gets really interesting, maybe even a bit concerning. We're seeing this weird trend. Central banks are trying to lower their main interest rates.
Right.
But the rates out in the actual market, the ones that affect your mortgage, your business loan, they're actually rising.
Ah, how does that work?
It suggests that the usual tools central banks use, their main levers for steering the economy, might be getting, well, blunt, losing their effectiveness.
Wow.
It's not just a normal market dip. It could be pointing to a bigger shift in how economic management works or doesn't work anymore. Maybe central banks are losing their grip a bit.
That is a paradox. Central banks pushing down, market rates pulling up. So for you listening, understanding this dynamic is pretty key for figuring out what might happen next with real estate, investments, the whole economy, really, and how much faith to put in those traditional economic tools. Things might be getting less predictable. Okay, now for what we call the main event. This really gets to the core of how governments are thinking about your money, your assets. We're diving into this big change in the Dutch Box 3 tax system. That's the part that covers savings, investments, second homes. Sounds technical, I know, but the implications are huge, way beyond the Netherlands.
Absolutely. The core issue in the Netherlands was this historical system where the government taxed people on a fictional return on their assets.
Fictional.
Yeah, they just assume, say, you made 4% on your savings and tax you on that assumed amount, even if your bank paid you like 0.1% or nothing at all.
Wait, really?
Yep, that was the system called the forfaitaire heffing, the fictitious tax.
Wow. That sounds, fundamentally unfair. And like a bureaucratic headache. What happened?
Well, people challenged it in court, and they won. The Dutch High Court basically said, nope, you can't tax people on income they never actually received. They cited the European Convention on Human Rights, specifically the part about protection against discrimination based on wealth.
Discrimination based on wealth. Interesting angle.
Yeah, and there was this case that got attention. An entrepreneur with, not a huge amount, about 10,000 euro in a collective owners fund, was still getting hit with this wealth tax. It just highlighted how far it reached.
So the court shut it down. What were the consequences? Must have been messy.
Oh, huge. The tax authority now has to go back, annul potentially millions of old tax assessments, and issue billions in refunds.
Billions. Ouch.
Yeah. And it forced them to basically design a whole new tax system that complies with human rights law. For you listening, this is just an incredible example of how individuals, through the courts, can challenge government policy and force a really fundamental change in how wealth gets taxed. Shows the power of pushing back legally.
Absolutely. A big win for taxpayers there. But okay, politically, how's this shaking out now? The Netherlands is likely getting a new coalition government. What are they proposing for this Box 3 system going forward?
Right. So this reveals the bigger picture. You've got different parties with different ideas. One likely coalition partner, the CDA, they're saying, okay, let's tax actual returns, move away from the fiction.
Makes sense.
And they also suggested a temporary break, basically, to avoid taxing value stuck in bricks for small landlords. They recognize there's a housing shortage, don't want to make it worse.
Okay, what about the other side? PVDA grown-links, the more left-leaning parties.
Their approach is different. They want to cut taxes on labor, pay for it by seriously hiking taxes on, quote, people with deep pockets.
Uh-oh. How deep are we talking?
Well, here's the kicker.
Yeah.
For them, deep pockets apparently starts if you have just 2,000 euros in Box 3 savings.
2,000 euros, that's not exactly super rich.
Not exactly. And their proposal, a 49% tax rate on the actual return you make, above a very small tax-free threshold.
49%, wow.
Yeah. And the Central Planning Bureau, an independent economic body, looked at these plans. They reckon it adds up to big tax hikes, about $3.6 billion for families, $5.7 billion for businesses.
Okay, so this new system from 2028, taxing actual returns sounds fairer, but there's a catch, right? You mentioned unrealized gains.
Exactly. This is crucial. The plan is to tax actual returns, but that includes capital gains on shares, say, from big stock market companies, even if you haven't sold them. So the value goes up on paper, you pay tax.
Even if you haven't cashed out.
Correct. There's an exception plan for investments in green or social startups. Those would only be taxed when you sell. But for regular stocks.
So wait, if my shares go up but I haven't sold anything, where does the money come from to pay that tax?
That's the million-dollar question, isn't it? You'd likely have to sell some of those shares even if you didn't want to, or dip into your savings.
That could force selling at a bad time.
It could. And here's another critical piece. While you pay tax on the gains, if your investments lose value, those losses are not offset against other gains or income.
What? So, heads, the government wins, tails, you lose.
Sort of. The idea, they say, is to avoid encouraging speculation with tax breaks for losses. But it means you could pay tax on gains for years, then watch the value crash, and get no tax relief on those losses.
That feels harsh.
It's a very significant shift. So for your financial planning, these specific proposals, that potential 49% rate taxing unrealized gains, no loss offset this, could totally change how you think about investing, how you manage your assets. It's something you really need to be aware of.
Definitely. Okay, so this whole fictitious tax thing in the Netherlands, was that totally unique? Or are other countries doing similar things?
Well, the Dutch way of taxing savings based on a purely fictitious return was pretty unique, yeah. Other countries have things that sound a bit similar, but they work differently.
Like what?
Like, France has something called a prélèvement forfaitaire, but it mostly applies to real estate, not your savings account. Spain has a wealth tax, the impuesto sobre el patrimonio, but again, it's mainly on high-value houses, over 2 million, not standard savings. Switzerland has a Pauschalbesteuerung, a lump sum tax, but that's usually an option for wealthy foreigners, not for everyone.
So the Dutch system was really out there on its own in that specific way.
It seems so. But stepping back again, it plugs into this wider global picture. Think about it. We've seen this huge value explosion in assets, houses, stocks, crypto, especially since the pandemic, right? Driven a lot by central banks pumping money in.
Yeah, asset prices went crazy.
But average wages, average incomes, they haven't kept up nearly as much. So governments, often facing big budget deficits, are looking at all that increased wealth sitting in assets and thinking, maybe we need to tax that more.
Right, they need the money.
Exactly. So the takeaway for you is, yeah, the end of that weird fictitious tax might sound good on the surface, but what's replacing it, not just in the Netherlands, but potentially elsewhere too, could mean much higher taxes on your actual wealth, even wealth that's just on paper, like unrealized gains. This isn't just a Dutch quirk, it's part of a global trend. Governments want a slice of that asset boom, and that could have big consequences, like people moving their money elsewhere, capital flight.
A really complex picture unfolding. Okay, let's wrap up. Wow, okay, that was quite the deep dive today.
Yeah.
We went from global bank scandals and digital policy fights to that really weird dynamic with central banks maybe losing their grip, and then landed squarely on this major shift in how wealth is being taxed, using the Netherlands as a key example. That fictitious tax is on its way out by 2028, but it looks like a new era of higher wealth taxes, maybe even on unrealized gains, could be coming in.
Absolutely. And that leaves us and you with a pretty big question to chew on, doesn't it? With governments everywhere looking harder at taxing wealth, while lots of people feel their actual purchasing power isn't keeping up, even if their assets look good on paper. How do we strike that balance? The balance between funding public needs and protecting individual financial freedom. And maybe more personally, what strategies do you need to think about now in this changing landscape to manage your own wealth and plan for what's coming?
That's definitely something to think about. It's a question that's certainly not going away anytime soon.